We'd like to welcome Daniel Liebau on stage, Modular Asset Management Chief Investment Officer of Modular and Blockchain Fund. Let's give it up once again for Daniel Liebau, ladies and gentlemen.
Good morning. Finally, we are back face-to-face meetings, right? I'm quite happy about that myself, actually. Maybe I introduce myself briefly. My name is Daniel. I'm the Chief Investment Officer of the Modular Blockchain Fund. Modular Asset Management is a local fund management firm. And I'm also active researcher and teacher in the field of blockchain. So I run a class on blockchain and also on DeFi at Singapore Management University. But today, I want to talk to you about a very important topic that has been a little bit overlooked in the past. And that is really how to think about sustainability characteristics of blockchain platforms and smart contract platforms more specifically. So there are four things that I want to talk about. First, I want to introduce two very important trends in investments. Second, I want to define for you what a smart contract platform is. Many of you already know what that is. And then I have some ideas on how to go about assessing the sustainability characteristics of these platforms. And then I'll say it all again so that you don't forget anything, and we wrap up, okay? I know there is time for lunch soon, so I won't keep you longer than planned for. Now, here are the key points of my presentation, just to sum it up for you in the beginning, and I'll do that again when we wrap up. A smart contract platform you can think of as an operating system that enables two peers to engage in peer-to-peer commerce. Okay? So what's very important to note is that they're not companies. They're not incorporated as firms in a legal sense. Often they're foundations. These smart contract platforms are very important. They make up about $384 billion worth of market capitalization. That's probably around 50% of the entire cryptocurrency market if you take Bitcoin away. What we pose is that only the sustainable platforms, and if you think about the word sustainable, right, what it means is actually is something that is going to be there for a long time. Only the sustainable ones will eventually be adopted both by entrepreneurs but also by large corporations. So understanding how we can assess these platforms and these characteristics of the platforms is very, very important if you're an investor, because it enables you to pick the winners. So let me just move on real quick to the two trends that I mentioned before. So the first one is obviously sustainable investing. And I'm showing you here a slide on fund flows into sustainability type funds. And this is only until the end of 2020, but we already know that this number keeps growing. But is ESG not only a scam? Many people in the crypto community argue like that. And I don't know whether you've seen in the press last week, this is Stuart, the, I think, still global head of responsible investing at HSBC. And he has some different views, right, on what perhaps is commonly being preached by a lot of the advocates of ESG. But is it a scam then? It's not a scam. But what's really, really bad is greenwashing. Do you know what greenwashing is? Greenwashing is basically this activity where you try to convince people or mislead people that your company, your project, is much more environmentally friendly than it is, right? Using ESG as a marketing tool only. What does it mean for us in the world of cryptocurrencies? Basically, nobody can claim to run an ESG crypto fund. And I'm sure our chief legal officer, who's somewhere around here, is very happy when I say that. No standards are defined, right? So nobody can really claim that they are an ESG crypto fund. What also doesn't help is that traditional ESG metrics that we use to analyze companies are not very useful when we look at decentralized blockchain networks. Right? So one of the metrics that is kind of paid attention to, for example, is board diversity. right? In a company, you always have a board. But then in a decentralized blockchain platform, you don't. So how would you assess diversity, right? Clearly, different metrics are required. So what we can do in absence of any standards is to start to think about what reasonable sustainability characteristics should actually be. And that's why my appeal or my recommendation is not to say, oh, ESG is against cryptocurrencies. I think we as a community need to engage this topic and basically try to understand which of these characteristics are relevant for the types of platforms that we work day in and day out. And from an investor perspective, that's important because it will enable you to take the right investment decisions. The second big trend, and that's, I guess, why we're all here, is obviously crypto. And despite the fact that we've been 13 years into the journey, I think it's fair to say we're still early. There are two trends, two kind of macro ideas that are very important and that drive cryptocurrency adoption. The first one is that platform business models have been the key business model to create online companies in the past decade or so. There are many examples, right? There's Facebook, Airbnb, locally we have Grab. All of these companies obviously grew to a massive size. The other thing that's kind of very interesting is to understand that 50% of mankind now are millennials. And millennials, unlike me when I was a little bit younger, don't like to work for big companies. Yeah? They like to do their own project. They like to develop their own products. And what that means is that all of these millennials eventually need some sort of operating system to build their products on top. And that also fuels the adoption of cryptocurrencies and especially smart contract platforms. So we expect that the market capitalization of cryptocurrency markets will continue to grow. Probably not as straight line as I put here on the slide, no? Will be a little bit more volatile. Okay, so real quick, what is a smart contract platform then? The purpose of a smart contract platform, as we mentioned earlier, is to enable two peers to basically engage in economic activity without any intermediary. Right? So you can think of it as an operating system for this economic activity that is decentralized. The token that powers these platforms is basically there to pay for infrastructure type services, right? So for example, transaction costs, if you think about Ethereum or any of the other ones. Now, how are these platforms different from traditional companies? Well, they are not companies. That's one of the key takeaways that I want you to remember. So we do need to think about them completely differently. An operating system in the traditional world is something like Microsoft Windows or Mac OS or Unix. In the decentralized world, it can be something like Ethereum or Polkadot, any of these type of platforms. We think about these platforms as a very interesting opportunity to get exposure to cryptocurrency assets. And why? Is because they're giving you a macro type of an exposure into these markets, yeah? Because lots of other projects are building on top of these platforms. Now, why do I keep saying that we need a different approach to assess sustainability for blockchain ecosystems rather than companies? So I try to make it very clear with this little slide. Right? On the left-hand side, your right-hand side, we have how a traditional company is set up. Basically, you have the operational part of the company that eventually is busy with operations and sales to sell to a customer, right? The customer is separate to the company. And then you have a governance structure that basically controls the activity of the company. Obviously, that's the board and then ultimately the shareholders where the value accrues to ultimately. But then you think about a blockchain ecosystem, it's totally different, right? So blockchain ecosystems don't have a board, they don't have often executive management. But what groups of characteristics do they have? Well, first of all, a lot goes into mechanism design in the beginning, right? A lot goes also into how technology is developed, and ultimately, community is one of the other key aspects. Think a little bit more about the communities. they're not as clear-cut as in the traditional world, right? In the community, you can have somebody who is an investor, a token holder. You can have somebody who consumes the service. At the same time, they are probably also a builder, yeah? Somebody who is a software developer. It's not uncommon. So it's a bit more blurred than in the traditional sense. Hence, we need different methods. Why is this all very important, you might ask? Well, it's important because institutional investors are interested in digital assets. There's this survey by Fidelity, I think it's run last year in September. It suggests that 71% of all the survey respondents are interested in digital assets. In Asia, the number's even higher, 81%. That's by number of survey participants. But then also, we note that there are only 3% of US and EU pension funds that have any exposure to crypto. And that doesn't mean that 3% of their AUM is invested, right? It means that 3% of the respondents are looking at it. So a large amount of these $50 trillion that pension funds actually manage doesn't touch crypto at all. So I would argue that institutional adoption that we always like to talk about hasn't really happened yet, okay? It's going to happen. These investors need something to analyze these different platforms. They cannot just, ape in, as we say sometimes in the community. They can't do that. So in absence of some generally accepted valuation model, all they have is basically to look at these characteristics that we're discussing today to make a judgment call on the quality of these platforms. But right now, nobody seems to care. Look at this. This chart shows the 5 most prominent digital assets as per this survey, right? And the first 3 ones, as you all know, so this is Bitcoin, Ethereum, and Litecoin, run on very energy inefficient consensus algorithm. The 4th one, Ripple, has huge concentration of wealth. So up to 64% of all of XRP tokens sit in the top 100 accounts. And as you all know, Binance has limited number of active validators each round, right? Only 21. So there might be something that we call validator risk, which I talk about in a second. So what we predict is that once institutional investors understand these sustainability constraints or characteristics, they will have to pay attention to them, right? Right now, it seems like nobody cares, but that's not going to continue forever. So then, okay, I've talked a lot. How do we do it? So let's start with the low-hanging fruit, right? So if you are keen to select a smart contract platform, the first thing that you can do is use or invest only in smart contract platform tokens that basically use an energy-efficient mechanism. Some might say, well, if it's energy efficient, it's not secure. Actually, there's already research published in top academic journals that suggest that that is actually not true. And if configured correctly, the security levels are acceptable for economic transactions. If we wanted to get a little bit more sophisticated, we can also calculate CO2 emissions per validated transaction. And what I would also recommend, obviously, because I have half my foot in academia and research, is to pay attention to what researchers are doing. There's a recent paper by UCL that basically compares the existing smart contract platforms under the sustainability lens, and there's some interesting insights in that paper. Why is this important? Well, it's important because this environmental characteristic determines whether there's going to be adoption. Yeah? So if you think about European companies, they will have to report their adverse environmental impact according to the TCFD standard to their shareholders. And that's across the supply chain. What that means is that if you launch an NFT on an energy-intensive platform, you will have to report that adverse environmental impact. So in your next earnings call, you'll get questions by your investors. Why do you do this? And not only that, you also have to purchase carbon offsetting contracts to basically become neutral. Yeah? That's a real cost. So companies will choose which platform they're building on, because otherwise it's just not viable. Second, let's talk about S for social. So here, one example is wealth inequality. So often when we think about it in a traditional world, to have more even distribution of wealth across a society is perceived to be a good thing, better thing. Right? What's interesting in the world of blockchains is that this wealth distribution is very transparent, right? We could just inspect the distributed ledger and see which wallet address owns how much. And here's the interesting thing. Obviously, as part of my work, I'm conducting a lot of empirical research. So we already found that a broader wealth distribution across all wallets on a public blockchain network is actually associated to excess returns. So in the end of the day, we're a fund management company. We want to do good, but we also want to do well, right? So looking at these characteristics really helps you to understand which platforms are ahead of others. Why? What's the explanation for this? It's very easy, right? If you have broader wealth distribution, then more people have a stake in the platform, then there's more software development activity that's good for the overall ecosystem. So what can you do with regards to wealth inequality? Well, you can compare different platforms using that metric. They're not the same. They're not all the same, right? Even if the correlations in markets are very, very high today, this is not very well understood. So you should look at how they compare against each other. Also, you can look at whether this metric improves over time and what the platforms are doing to perhaps improve their situation. G for governance. So let's move on to validator risk. So as you know, in the blockchain world, we replace a central coordinator type of role with a validator or miner. And validators are, you can think of them as basically the auditors of the blockchain world. They also propose and validate new transactions, right? So unfortunately, they can get hacked and they can also go rogue. So these are two risks that we need to be aware of. So it's important to pay close attention. And just to kind of throw at you a recent example of why this matters. Some of you remember the Ronin hack recently, right? Show of hands. About $600 were lost, right? So if you look into the details, the Ronin platform was run or validated by 9 validators, 4 of which were run by one company. It's a very high hacking risk, right? So when we assess these platforms in our day-to-day work, we really pay attention. How many validators are out there? But then more importantly, how many of these nodes are actually run by the same entity, right, to manage this risk? All right, I guess I'm running out of time. So I could talk about this for a long while. Obviously, I only picked out 3 examples of data points that we're looking at or characteristics that we're looking at. In our day-to-day work with the investment strategy, we have about 25 of these metrics that we update continuously. So just to summarize, right? Smart contract platforms are the operating systems for peer-to-peer commerce, and they're not companies. Smart contract platforms are extremely important because they already make up about 50% of the market cap if you subtract Bitcoin. And in our view, only the sustainable platforms will really be adopted. And that is true for entrepreneurs, but also big companies. So if you were an investor and you wanted to pick tokens that are sustainable, then you can try out some of the characteristics that I shared about, and that will help you eventually pick those who are really sustainable and can stick around for a longer time. That's pretty much it. I think we don't have time for Q&A, but I'm going to stick around for a little while. If you want to reach out, then we can have a quick chat. Feel free to connect on LinkedIn as well, and if you want to learn a little bit more about what we're doing at Modular Asset Management, then please check out our website, and then I'll be happy to answer your questions offline. Thank you so much for paying attention, and yeah, really good to be back in the face-to-face mode. Thank you. It's okay.